In this video, we're going to work through example 2. It looks very similar to example 1, but now we're going to make two different assumptions here. In part A of example 2, the requirements say we're going to assume that Washington Company does not have significant influence over the investee, which is Allied Company. So therefore, Washington is going to use the fair value method. Very similar to our last example, Washington Company purchases 48,000 shares of the stock of the investee. We have some information about Allied's net income, dividends, and fair value of Allied stock. Please try to have this example written out on the side as we work through the problem together. Remember, the first thing that we need to record here is the purchase, the acquisition of Allied Company's stock. A is use the fair value method. Remember, so far we've learned two different types of accounting for equity investments. One is the equity method, and the other is the fair value method. The fair value method says we don't have much of the stock. The acquired company's results are not we're not that highly affected by them, so we value our equity investment at the fair value of the shares. Okay, so on part A, or item 1, on January 1st, Washington Company purchases the shares of Allied Company. We're going to do the same thing that we did the same thing we do anytime we acquire shares. Increase the asset equity investment, 480,000, and we give up cash. Item 2, for the year ended 2019, Allied Company reported net income of 200,000. So what's the entry that we need to record here? We're using the fair value method. Remember, we only care about the net income of the investee company when we're using the equity method. So what do? We do nothing. Ignore net income of the investee. What do we do? Well, at the end of the year, when we know the company's fair value of the investee's stock, we record that increase in fair value to the balance sheet with the unrealized holding gain or loss going through income. So we do need to record the change in fair value. Of Allied stock. And remember, we don't record it directly, this unrealized holding gain or loss, we don't record the change in fair value directly to the equity investment account. Remember from last week, when we have that change in fair value, we're going to use the fair value adjustment account. This is a separate valuation account. It acts like an asset, so we increase it with a debit. We decrease the fair value adjustment account with a credit. On the balance sheet, the investor looks together at the equity investment account plus the balance in the fair value adjustment account to see what its portfolio is recorded at fair value. All right, by how much do we increase the fair value adjustment account? We have 48,000 shares. They originally recorded here in item 1 at $10 a share, and they are now at $12. So that difference of $2 a share gets recorded to the fair value adjustment account. And the other side of this entry, this is an unrealized holding gain or loss. On an equity investment, this is going to go directly through income. With investments in common stock, we're never going to have a UHGL-equity account. We're only going to use UHGL equity when we're accounting for available for sale debt investments. Item 4. On January 28th, 2020, Allied Company announced and paid a cash dividend. So the company whose common stock we own paid a cash dividend. Therefore, we get cash. We don't get the full 100,000. We get a portion of that. We own 20% of Allied's common stock, so we get 20% of that dividend, or $20,000 in cash. Now, the other side of this entry depends on the accounting treatment. Under the fair value method, remember we record this as dividend revenue. If this had been the equity method, we would decrease the value of our equity investment, but fair value method, we record the dividend revenue. 5, for the year ended 2020, Ally reported a net loss of $50,000. Well, we're using the fair value method, so we ignore the net loss. And 6, at December 31st, 2020, Allied shares have a fair value of $11. So the market price per share decreased by $1. So we do have to, now we are going to decrease the fair value adjustment account. Remember, we don't decrease the equity investment account directly. We use the separate tracking account. We had brought our shares up to $12 in our last entry, in item 3. Now we want to record the decrease from 12 down to 11, so $1 a share, or 48,000. And the debit here is going to be to the unrealized holding gain or loss income account. That's all we have to do under the fair value method. Let's compare this to how the entries would look if we had assumed instead that this 20% holding in item B, assume that Washington's holding in Allied does allow them to exercise significant influence, and therefore the company uses the equity method. All right, in this case, well, the accounting for the purchase of the stock is no different. Debit equity investment and credit cash for $480,000. 2, for the year ended 2019, Allied Company reported net income of $200,000. If we're using the equity method, we do care. We say we have so much of that company's stock that some of their income is our income. How do we record that increase of the investee's income? We record an increase to the equity investment account. So I'm going to debit equity investment for Washington Company's proportion of the net income. We own 20% and the net income was $200,000. Equity investment increases by $40,000. And what account do we credit? It's going to be investment income. We own so much of this company that their income is our investment income. Item 3 says at December 31st, 2019, the shares of Allied Company have a fair value of $12 per share. What do we do with that information? Ignore it. Under the equity method, we ignore the fair value of the shares of the investee's stock. On January 28th, 2020, Allied Company announced and paid a cash dividend of $100,000. All right, so we're receiving cash. We don't receive the entire $100,000. We receive 20% of it. And take a second to think about what is the credit side of this entry. It's not dividend revenue. It's only dividend revenue under the fair value method. This is the equity method, so we reduce the equity investment account. For the year ended 2020, Allied reported a net loss. Well, we own so much of this company that their net loss is our net loss. So now I want to decrease the amount of the equity investment. So I'm going to credit equity investment to reduce it. And this was a $50,000 loss, and we own 20% of the shares, so we need to take 20% of that loss. So I credited my asset equity investment. What's the other side of this journal entry? I'm going to debit investment income to reduce investment income. Six, as of December 31st, 2020, Allied shares have a fair value of $11 per share. What do we do here? We do nothing. Under the equity method, we ignore the fair value of the shares. That concludes Chapter 17, Investments. Now I would like you to work on the practice questions that are given on Blackboard. Try to do them without looking at your notes as much as you can, and then check your work to the solutions. The next video we'll move on to Chapter 18, Revenue.